A Mennonite community started lending each other money in 1792. No bank, no application, no interest charged. That system is called the Wiesenamt, and it is active today. Borrowers needed only two neighbors to vouch for them. 200 years passed. Then in 1978, one Supreme Court case erased the laws protecting every other American borrower from runaway interest. The Mennonites never noticed. Their system kept running the same. Stay with me. If you own a house, a shed, or a quarter acre, this is the part that changes everything. Picture the place. Chortitsa, a Mennonite settlement carved out of the Russian steppe in the late 1700s. No vault, no teller window, just a ledger, a few elders, and a fund called the Wiesenamt, literally the orphan's office. It started by managing money left behind for widows and children, but it grew into something far stranger, a working credit system for an entire colony, run without a single licensed banker. Here's the part that sounds impossible until you see how simple it actually was. If you needed money for seed, for a roof, for a wagon, you didn't fill out a form. You found two people in your community willing to put their names beside yours. That was the entire underwriting process. Not a credit score, not a property lien, just two neighbors saying, in effect, we know this person and we believe they'll make it right. Stay with me, because this is where it gets strange. That system didn't collapse under the weight of human nature the way you would expect. It worked. Loans got repaid not because of legal threat, but because defaulting meant facing the same two neighbors at church on Sunday. The collateral wasn't land, it was reputation. And reputation, it turns out, is brutally effective collateral, more effective in many ways than anything a modern bank can repossess. Now here's the question worth sitting with. Why doesn't that exist anywhere else? Why did an entire continent build its financial system around interest, fees, and credit bureaus, while one community quietly ran the opposite model for over 200 years, and it still runs today in pockets of Ontario and Manitoba, almost unnoticed? Because this wasn't an accident. It wasn't folk superstition or rural stubbornness. It was doctrine, deliberate, argued, and defended for centuries before the Wiesenamt ever existed. Open Deuteronomy 23:19, and you will find the line they built it on. Do not charge your brother interest. Not a suggestion, a boundary. By the early 1500s, Anabaptist communities across Switzerland and Moravia were taking that boundary seriously enough to die for it. In 1528, a Swiss brethren named Hans Leopold was recorded saying that if a brother was in need, the community considered it their duty before God to help him, whether or not he could ever repay it. That's not folklore. That's a documented statement from a man executed for his faith the same year he said it. And here's the detail that matters. Even people who hated these communities admitted the system was real. In 1560, a Reformed pastor named Heinrich Bullinger, no friend of the Anabaptists, writing specifically to expose them, confirmed that they taught every believer was duty-bound to use his possessions to meet the needs of any brother who was struggling. He wasn't praising them, he was warning about them, but in doing so he proved the system existed, organized, intentional, and widespread enough to alarm outsiders. This is why it scales. This wasn't one generous farmer helping his neighbor once. It was a structural commitment, passed down, formalized, eventually written into the Wiesenamt's ledgers a quarter century before the United States had its first central bank. So picture what that means on the ground. An entire colony where credit did not come from a financial institution extracting a profit margin. It came from people who already trusted you, formalized just enough to keep records straight. No interest skimmed off the top, no fees for falling behind. The system existed to get you back on your feet, not to keep you paying forever. If you own a house, a shed, or even a quarter acre right now, notice what is missing from your own financial life. Somewhere between then and now, that model disappeared almost everywhere except inside these communities. The same model quietly survived wars, migrations, and depressions in Eastern Europe, then crossed an ocean and kept running in rural Canada like nothing had changed. That is not nostalgia talk. Mennonite savings and credit union branches in Ontario still take deposits at zero interest, specifically so they can lend at zero or near zero interest, by design, not by accident. It is the same architecture as 1792, just wearing a modern building. But something did change. Not for them, for everyone else. In 1978, while the Wisenant was still operating exactly the way it had for nearly 200 years, something happened inside the American legal system that nobody at the time fully understood the size of. A single Supreme Court decision, 9 justices, 1 unanimous vote, and it quietly rewrote what interest was even allowed to mean for the rest of the country. The Mennonites didn't change a thing. They didn't need to. Their system had never depended on the laws that were about to collapse. And once you understand why, you'll understand why this story didn't end in Russia or Ontario. It ended on American soil, the same decade everyone stopped asking who lending was actually supposed to protect. Everyone else's protection did. Here's the part nobody tells you. The case was called Marquette National Bank of Minneapolis versus First of Omaha Service Corporation, decided December 18th, 1978. Unanimous, 9-0. And on paper, it sounds almost boring. A dispute over whether a bank in Nebraska could charge Minnesota customers Nebraska's interest rate instead of Minnesota's. But that's the detail that matters. The Supreme Court said yes. A national bank could export its home state's interest rate to every customer in the country, no matter what protections that customer's own state had built. Minnesota had a usury cap. It didn't matter anymore. Overnight, the entire structure of state usury law, the laws that had kept interest rates capped for generations, stopped functioning the way it was designed to. This is why that number matters. Before 1978, roughly half the states in the country still enforced real limits on what a lender could charge. After 1978, banks simply moved. Citibank shifted its card operations to South Dakota. Delaware gutted its own caps to compete for business. Within 7 years, revolving consumer debt in America nearly tripled. Not because people suddenly needed more money, because the floor underneath borrowing had been quietly removed and nobody outside a courtroom even noticed it happening. Notice what happens next. While that floor was disappearing for everyone else, the system built on 2 neighbors and a handshake just did not react, because it never needed legal protection in the first place. It was never built on rate caps. It was built on something rate caps could not touch: trust, enforced socially instead of legally. Here's where it gets uncomfortable. You would think a system like that, older, simpler, working without extracting profit, would have been studied, copied, maybe even encouraged. It was not. In Manitoba, as provincial regulators expanded oversight of financial institutions, several Wisenant organizations were pulled into compulsory regulation and finally incorporation, not because they were failing, because they were operating outside a system that existing financial institutions were built to control. Once forced into formal incorporated structures, a few of those funds collapsed during the economic strain of the 1930s. The same funds had quietly survived famine, war, and migration on their own terms for over a century. I want to be careful here, because this is not a story about a secret ban. Nobody passed a law in Washington specifically targeting Mennonite lending circles. That is not the claim. The claim is something colder. The same pattern shows up again and again in different countries, different decades. Informal, no-interest community lending grows large enough to be noticed, and the moment it does, the systems built around extracting profit start applying pressure. Sometimes that pressure is a regulator. Sometimes it is a court ruling that never mentions community lending at all, but quietly removes the protections everyone else relied on instead. Now here's the proof object I promised you. In 1945 in Goshen, Indiana, a Mennonite leader named Ori O. Miller helped start something called Mennonite Mutual Aid. Its first job was almost unbearably specific: give low-interest loans to young Mennonite men coming home from civilian public service after World War II, men who had refused combat on religious grounds, and came back with, in the words of the people who built the fund, little more than the clothes they were wearing. That fund didn't stay small. It didn't stay simple either. Eventually, it grew insurance arms, retirement funds, and a foundation. But the core idea never changed. By the time it merged into what is now called Everence, it was managing over $3 billion, not as a bank chasing profit, but as a mutual aid network still rooted in the same idea written into Deuteronomy. Lending exists to help your brother stand up, not to keep him kneeling. Sit with that contrast for a second. The same year America's legal floor for borrowers was being quietly removed, the Mennonite alternative wasn't shrinking, it was scaling, quietly, without headlines, without regulators forcing it into anything, because by then it had built enough size and structure to defend itself. Here's why this matters for you, right now, sitting wherever you're watching this. You don't need 200 years of theology to use the bones of this system. Credit unions still operate on the same basic principle, member-owned, member-funded, lending back to the same people who deposited the money, with no outside shareholders skimming the difference. Mennonite credit unions in Ontario and Pennsylvania still run loans funded by zero-interest deposits on purpose today. If you own a house, a shed, a quarter acre, the question isn't whether this model still exists. It does. The question is whether you've ever been shown it as an option. Because here's the part that should make you angry, just a little. This was never complicated. It was never expensive. It required two neighbors and enough trust to write a name on a ledger. It was buried not because it failed, but because it threatened something much bigger, an entire industry built on the assumption that borrowing has to cost you something extra forever. You now know the difference between a system built on trust and one built on extraction. Most people never learn that difference exists. So look around where you live. Is there an old credit union nobody talks about? A mutual aid fund with a name nobody's heard since their grandparents mentioned it? That's not nostalgia. That's infrastructure, still standing, waiting to be used. Because the Weisenamt was not the only system quietly pushed to the margins while everyone assumed there was no other way to borrow money. There is another one, hiding in plain sight on farms across this country, and it has nothing to do with banks at all. That one is next.